Welcome to the Confident Retirement Podcast. How confident are you when it comes to life's biggest money decisions? What is real financial peace and how can you get it? Chris Flaming and Mark Peachy are the founders of LPF Advisors in Sarasota, Florida. They bring together the brightest minds to show you how to have a more confident financial future. They empower listeners with common sense concepts and financial wisdom. And now, here are your hosts, LPF Advisors. Welcome. I want to thank everybody for joining us on the Confident Retirement Podcast brought to you by LPF Advisors. This is our second annual economic outlook. And I'm your host, as I mentioned, Chris, one of the co-owners of the firm. We are so glad you're joining us. And I'm very excited to welcome back our featured guest, who I will introduce in just a second. First, I have to give our quick disclaimer. The information we provide is opinion, not necessarily that of our firm or the platform. We provide general education info and not any customized recommendations. You should consult with your own financial, tax, or legal advisors or attorneys on your specific situation. And nothing we discuss today should be construed as tax, financial, or legal advice. Holy smokes. Okay, well, today I have the pleasure of welcoming Phil Blancato back. Hi, Phil.
How you doing, buddy? Good to see you.
Well, yeah, we're here.
You're doing the whole gray thing today. You got the gray hair, the gray glasses, the beautiful white teeth, and even the gray beard. You look like a modern day handsome Santa Claus. I don't know what I'd call you.
I am. I just need the belly. I'm shampooing with toothpaste now to bring out the silver in my hair.
No, you tell me that you don't do it. You probably are doing it.
No, I'm not. That's what I tell my daughter's friends, but I'm not doing that. Phil and I go way back. We've even done some karaoke together. We do Vegas show tunes as our specialty. He has 35 years of industry experience. He's been quoted in the Wall Street Journal, frequently appears on CNBC and Fox Business. He's a regular speaker at industry conferences. I've seen him many times. He always has the biggest audience regarding investment management and macroeconomic theory. He's, as I mentioned, also a good friend. So, Phil, thanks for being here and welcome to the show and providing your insights.
My pleasure, buddy. You know, you and I go way back, as you mentioned, and I think we both share the same passion, which is to help folks understand what's happening in the world when it comes to their money and making them not panic, like my book behind me, and hopefully realizing that there's always a way to make money in markets. Sometimes it's easier than other times.
That's right. We're trying to guide people with our wisdom. There's lots of knowledge out there, but the wisdom is in short supply. So hopefully we'll dispel some of that stuff today and get that out. So we're almost 2 months into 2025. We're here. It's mid-February, almost March, and lots happened since the inflation was really high in 2022. And like all humans, we're very quick to forget recent events and just give into what's being out there in the media right now. So I was hoping you could give our audience some perspective, maybe start with a review of the major events or economic markers over the last 3 years.
Well, you know, that's a great starting point because I'm going to use something we never are supposed to use, which is this time is a little different. And by that, I mean, and markets never want to say that. In fairness, history of markets rhymes are never exactly the same. But what you found, Chris, and this is really quite simple. If you go to a degree post-pandemic forward, we started hiking interest rates at a time when the U.S. economy was doing just okay. You know, we had come out of the pandemic. It was obviously we went from being shut down to just getting off the mat. And understand, normally you hike interest rates when the opposite is happening. Mm-hmm. You're hiking interest rates to cool off the U.S. economy, like say in the 1980s or in the late 90s. And you do that because you want to slow down borrowing. The higher the interest rate, the more costly it is to borrow. You want to slow down spending. Folks spend less money because their credit card interest payments are too high. Or you just simply want the U.S. economy to become more difficult to grow by making costs higher. So and that's generally done to slow things down so you don't get a big bust or you don't get runaway inflation like we had in the early 80s. This time, the economy was not hot. We simply hiked interest rates because we had a supply shock. We all wanted to buy a bunch of stuff. We had money from the federal government giving us money, but there was no stuff to buy. You went to the supermarket and everybody wanted a banana, and there were no bananas on the shelf. If there was one bunch, everyone was willing to pay 10% more for it. Mm-hmm. And truth be told, prices are up 40% from 2019 to today. Now the reverse has happened. We began to cut interest rates, and normally you cut interest rates when the U.S. economy is really flagging or having a very difficult time, and yet the U.S. economy is doing pretty well. When you look around, Now, I know some folks may not agree, but the unemployment market is extremely healthy. It's one of the lowest unemployment numbers of your lifetime. Now, there's some disparity between what's your skill set and what's available, but by and large, anybody who wants a job can get one. You saw minimum wages explode, really increase significantly over the last, really since 2017 forward. We've had average rates for people who make less than $100,000 a year be significant, 4, 5, 6% increase. My favorite analogy is the Amazon guy or girl who works in Amazon warehouse starts at $26 an hour.
Mm.
And so you think it's things like that. And a McDonald's employee in New Jersey, where we have a relatively high minimum wage, is $18 to $19 an hour. That's quite a bit of money considering where they were pre-pandemic. My point is,
Mhm.
you don't have a labor force that's in dire need of rescue. You don't have an economy that's in dire need of rescue. So what you're doing is you're cutting interest rates, which is usually a stimulant. We're making it less expensive to borrow, less expensive to go spend money, less expensive to move money around the system. And that usually means growth. So what happened, what's a little different about this time is we had this amazing post-pandemic euphoric environment. And there was three
Mhm.
things that drove it. Incredible spending by the federal government, money being handed out. The AI revolution clearly has had a profound impact on where markets have gone. And then finally, the US economy and the US consumer being really healthy. And that's what's a bit different is that we've never seen the American consumer this healthy. So when you look at the last 3 years, some of it's artificial. When you look at your home value, I would bet, Chris, where you live, and people you know, you could say your home's probably up 40% since 2019, depending on the market that you're in. Your stocks are certainly should be up about 40%, if not more. And depending on your job, you might have had a pretty significant increase. So all that is a bit about the federal government printing money. So all that happened was you had this artificial stimulus of money. It raised all these prices. Folks are really wealthy, especially the boomers out there. And you end up in a scenario the market just had this sugar high that's really gone crazy to right now. And I'd argue the sugar high is changing. It's gone from pure sugar to just maybe a little bit of sweetener, and that's the difference.
Mhm. Okay. And do you think well, I know you got like several economic themes that you come up with every year, and you've been very forthright. Like sometimes you get them right, sometimes you maybe miss the mark a little bit. Like everybody, it has to drive the decisions that you make. So before we kind of go into those, I want you to explain quickly what's meant by macroeconomic theory, because I know that helps shape your ideas, and then we can kind of dive into those economic themes that you have for 2025, and we can talk about those briefly.
That's a fun way to describe what you and I do for a living. So years ago, we used to buy and sell on a commission. And it's important to this part of the story. So if I bought you something or we both, we earn money on it. We got rid of all that. Now you're paying us for advice. And why that matters is every time we buy and sell, it's for free. There's no cost whatsoever. We all earn money based on the advice we give you. So that's really important to this part of the story because when you look at macroeconomic theory, it used to be very difficult to change a portfolio based on macro headlines. So in other words, if I made a decision in January for you to be in large cap stocks like Nvidia, and then I come to February and say, I got that wrong. I need to change the value. It was a cost to buy and sell. It was
Mhm.
prohibitive to building a good portfolio. Well, we got rid of all that. So when we look at macroeconomic theory, we want to analyze what's happening in the world and in the U.S. economy. And then based on what's happening, was it the consumer growing or shrinking? Is the economy growing or shrinking? Is spending growing or shrinking? Is inflation higher or lower? Are interest rates higher? All these different pieces. We try and put them together, make our own little Lego puzzle of what's happening in the economy. And each little piece has its role. So when we look at putting the pieces together, we then make a decision to the portfolio. And the beauty of this is it doesn't have to be a moment that's fermented in time or so. It's allowed to be used as a starting point. But
Mhm.
as you go through the year, if you need to make changes, you do, and there's no worry about getting things wrong. So we look at macroeconomic environments, and sometimes that puzzle, maybe this piece belongs better on the top than on the bottom. And what I mean by that, we tweak our theory. And so we have a starting point where we end the year, but as we go through the year, as things change, we
Mhm.
change our thesis and we change the portfolio. So it's very fluid, and that's what makes today's investing so much better than where we were years ago. The costs are lower. We can be more active in your portfolio, and we can change based on things changing. So, for example, when you pay less for gasoline at the pump, and right now your gas prices are probably a bit low, did you know that for every 10-cent drop in gasoline prices, it's $50 billion in extra spending for the U.S. consumer? That's a lot of money. So when we saw prices come down here, it says, wow, that helps the consumer be that much better. Those are little things we'll look at to say, should we be more aggressive on U.S. stocks and the U.S. consumer, or should we be more aggressive on international stocks, the international consumer, where they haven't had that price break? So those are things how we look at macroeconomic theory. And because of the way we work together, we're able to do things in the portfolio that change. That's how we begin this relationship.
Okay. So with that in mind, let's dive into some of the themes. Maybe you already kind of were talking about this, but let's start quickly with interest rates. You say that they're likely to stay elevated. So what does that kind of mean for the economy? And I know I have a lot of discussions with clients about what that might mean for the bond market.
Yep, it's a good question. So last year, to go back to this year, then this year, last year we thought interest rates would fall rapidly, and they did. They went from 9% to basically 3. This year, we think they're kind of sideways. They're stuck in this sideways horizon. And the reason why is because some of the things we've already talked about, the U.S. economy is good enough and the consumer spending enough that it's hard to see inflation fall. Why would inflation fall? Because demand shrinks. Back to my banana analogy, if people want less bananas, prices of bananas fall.
Mhm.
Remember supply demand from when you were in high school economics or something. So in that sense, when demand falls, and demand can fall for a variety of reasons, but generally it's because of higher prices or higher interest rates, it means folks are going to spend less. What we're seeing is folks are not spending less. And the reason why they're not going to spending less is they got a good job again. They've saved a lot of money. Their stocks are up. And they're living with this bout of inflation and kind of accepting it. It's not great.
Mhm.
As I mentioned, prices are up a lot. But if you're old as me, I'm 57. I grew up from 1980 to really 2000 with average rates of inflation being around 4%. It was
Mhm.
before that period of time they were much lower, and after that period of time were much lower. But the average rate historically in our lifetime is about 4.
Mhm.
Historical, the whole gamut of times, call it 1920 to now, it's about 2. But my point is, usually you look at the theme for the bond market as interest rates fall. And here's what goes back to the beginning. Why it's a little different this time. You look at history. Every single time the Fed cut interest rates, the bond market had an average rate of return of 10% or better for the next 5 years. Bond
Mhm.
market being recognized as the 10-year U.S. Treasury. And the way bonds work, everybody, it's real pretty simple. As inflation or interest rates, and they're tied together, fall, bond prices go higher. Why? Well, simple example. If you bought a CD a year ago at your bank, you probably got a 5% CD. If you went to buy it today, you'd get 4. Interest rates have fallen. So which one would you rather have? The one for 5. So what does the
Mhm.
one for 5 do? It goes up in value because more people want that one versus the one for 4. That's
Mhm.
all it is. It's just
Mhm.
supply demand. Where can I get my best yield? So the bond market normally does really well when interest rates start to fall. And as they did last year, the bond market did okay. We expected it to be a bit better than it was, but it was okay. That's why we got that one kind of right. It was up about 4 to 5% depending on the market you looked at. Whereas this year we have muted expectations. We think you're going to get about 4 to 5% out of your bonds. Why? Because bonds are yielding just 4 to 5%.
Mhm.
We don't think the price of bonds are going to change a whole heck of a lot because we think interest rates and inflation are basically going to stay around where they are. They may go up or down by a quarter of 1% or half of 1%. But in order for inflation to fall a lot, you would have to see consumer demand really fall off. And we're just not seeing that. The U.S. economy is doing okay. It's doing pretty good.
Yeah.
And that's why it's holding on for a while. If you don't
Yeah.
mind, can I do
Yeah.
something fun? I'd love to pivot for a second. Just to make one good point about the U.S. consumer, I think sometimes we forget about. This phenomenon since 2019 is something that you kind of wrap your head around. Wow, it's a real change. The top 20% of Americans are worth $40 trillion more, 35 to 40, depending on where you slice it. The bottom 80% are worth 14 trillion more. So you go, oh, that sounds terrible. Well, not really, because the top 20 are the ones who earn the most and they have the most stuff. If you
Mhm.
look at the percentage increase, they both increase by the same percent. Why I'm making this point is whether you made less than $250,000 a year from 50 to 250, or you made more than 250, you had this great lift off in everything you're worth. And what it means today is this is a little bit different. The top 10% represent 50% of American spending. The rest is everybody else. Why that's really relevant? Well, those are the folks with the most money. Who are those folks? Those are boomers. Those are folks who are probably older than the age of 65, and they've got more wealth than they ever thought they would have. So by them spending, it's an economic catalyst. So that's how we connect consumer strength to everybody else. Now, if everybody else slows down because of higher interest rates, then we'll get inflation to fall modestly.
Mhm.
But the two have to work harmoniously together. Why I think the U.S. economy hangs in there? Because I don't think those top 10% are slowing down anytime soon. Royal Caribbean had the best 5-week booking period ever in its history in the last 5 weeks. Delta has seen an increase of 8 to 10% in first class seats on their airline for 2025. And we can go on with these things.
Yeah.
All these places people want to spend money are happening. So
Yeah.
when people get a little bearish about the U.S. economy, okay, there's going to be bumps because the federal government's not throwing in a bunch of money anymore. But I don't think we're in some sort of horrific black swan event. There's things that could cause it,
Yeah.
but not that.
Right. So barring those, I'm seeing that too. I mean, the restaurants are still full and everybody's still out eating and doing stuff. We have our mall in Sarasota is packed. I mean, a mall. Those
Go
have all
figure
been
that out.
closing. I know. You go there and there's all these people walking around. So I'm with you on that. So let's pivot kind of into your theme on US equities and stocks. So you say they'll normalize from recent outperformance, last few years outperformed, but still finish the year in positive territory. January was a pretty good indicator. I mean, January
Yeah.
was positive. So what's your thoughts on that?
Well, we're almost up 3% on the year, 2.75, give or take the day. Now, I'll pivot because I'll tie two things together. I don't like being invested in anything but the United States. Now, in fairness, 40% of the revenue from the S&P 500 comes from
Yeah.
multinational
Yeah.
companies. So I'm
Right.
getting international exposure by being in the S&P. But international market, which we're negative on, guess what? That one's up 8% on the year, almost triple the S&P. And I'll get into that for a minute. But the reason why we like the U.S. stock market, it's not because of the brilliant Magnificent Seven. And for all the talk about them as them and what they are, they're pretty incredible. This has never really happened before. Those seven stocks make up, if you combine all the stock markets of all of Europe together, those seven are bigger. If
Mhm.
you take those seven and tie them together, it's the third largest country in the world. If you
Mhm.
look at Nvidia's earnings growth, and I'm not recommending you buy it or sell it, just the company, you look at their profits, they're in the 40th percentile. So these are companies that are really expensive to buy because we look at their price and divided by how much they earn. It's classically called the PE ratio.
Mhm.
And you look at those ratios and there's averages you want to be within, all of them are above average. But they make a lot of money and they're the drivers of the economy. So what I suggest to folks is we like the US market. We think it's a much more normal year because we don't think those seven will drive too much higher. Why?
Mhm.
It's really hard to make a $3.5 trillion company like Nvidia become a $7 trillion company. That's a heck of a lot of growth that you need. Walmart, for example, a gigantic company, just came out with earnings and they did $180 billion in revenue. It's a lot of money, but it's really hard to make it much bigger because that means that's the only place people would buy stuff at. So it just can't
Yeah.
grow bigger. My point is, I think it's time to buy other things other than the seven stocks. And if you look at value stocks this year, with this growth stocks, clearly a winner. What we've been advocating is take some profits from growth. Go buy your classics, Caterpillar and John Deere and good banks and things that are somewhat consumer centric. We call them mid cap and small cap stocks that are much more sensitive to consumer spending. By the way, small caps down 2.5% on the year. Doesn't mean you run away. Don't panic. But that just means that these things take time to work out. It's not a one-day magic pill. So while I still think the U.S. consumer is strong, I still think it makes sense to buy other things besides those really expensive Mag 7. Do think this year is only a normal return. Normal return of the stock market going back to 1920, 1910 is 8% for large
Mhm.
caps and almost 10 for small.
Yeah.
So I think we've got to move away from the last 10 years on average, S&P 500 is up 14%.
Yeah.
Last 5 years, it's up 11. Those are absurd returns. And I just don't understand why we can't get folks to understand that you shouldn't expect that. That's not the way
Yeah.
it works. So
Yeah. And go ahead.
volatile year, average year. Sorry.
Okay. And that's a good segue because you kind of talk about in your economic themes where maybe smaller mid-cap growth could be poised to do well, recover for some reasons that you just mentioned. So maybe just go into that briefly, your thinking on that.
So we looked at the risk of small caps versus large caps, and believe it or not, they're kind of been acting very similar. Used to be you take more risk in small caps
Mhm.
and you get better return. That hasn't happened in years. So we don't think you're taking on a lot more risk by selling some of your big, large growth names and going to those smaller names. We do think this is a year that, and a correction of 10 to 15% seems absolutely normal. They happen, by the way, about every year.
Yeah.
3 or 5% are totally normal. We haven't had any. It's just been
Yeah.
straight up. Now, really, since the election, in fairness to, and I'm not political, I don't really care left or right. I need to make your own money based on it. There's a problem with tariffs and things like that. That could be an issue. But besides that, for a minute, you look at post-election, we had this big run-up, and then we had a kind of a sell-off, and now we're basically just slightly above where we were post-election. My point is, I think you can own other companies that are less expensive than the Mag 7 because they won't add a lot of volatility to your portfolio. And if we get a market that's relatively grinding higher, classically called climbing the wall of worry, then I think those stocks will do really well. Here's why. When you walk into a supermarket and you look on the shelf and you think, okay, what do I want to buy cereal today? Or I want to buy whatever fruit. I want to buy for Florida, I want to do fruit. And you see those really easy ones to peel that are really expensive, or the ones that are much harder to peel but they're not as expensive. Well, you probably get tired of spending that extra money. And once in a while, you're going to pivot to buying the less expensive one. When you think about stocks, it's the same thing. Nvidia is a very expensive company, good company, easy to peel, very tasty. So is Microsoft, so is Amazon. But once in a while, buying that other stuff, instead of buying 4 or 5 of those really easy to peel and juicy ones, you might get a whole dozen of the ones that are a little bit harder to peel, and you get a lot
Mhm.
more for your money. That's
Mhm.
what's happening in other places of the market, whether it's large cap value or mid cap stocks, even small cap to a degree, even though they had a rough time that last week. We think there's better value in other places. This is classically known as diversification. And in fairness to the non-diversified investors, since 2008, all you had to buy was the S&P 500 index fund and nothing else mattered. I think that's over with. Why? It's really simple. The federal government is no longer here pumping in money into markets like we did after 2008 and after we did after 2013 and after we did after 2020. Assuming the market, the economy, the government's getting out of the way,
Yeah.
back to normal, and normal means normal returns, normal corrections of volatility, and chances to do well in other places.
Yeah. And that's where diversification comes in, as you mentioned. So
Yeah.
let's pivot to the housing market. Nationally, inventory is kind of shrinking, kind of down. Affordability, maybe not all-time lows as far as afford or hard to afford a house. So that's certainly a concern. Maybe speak to that and what kind of an impact that may have on people.
I'll throw you a shocking strategy. Did you know the average age of a person taking out a mortgage today is 59 years old? Can you imagine that?
Is that
So
new mortgages or
new
refinances?
mortgages,
Okay,
new mortgages.
okay, okay,
And that could be the piece that's just refinancing with very little because no one's refinancing
okay.
higher, right? So,
Yeah, right.
and the only people buying those people with second homes. So you're not seeing as a primary home market just last month, 9% down for existing home sales.
Yeah.
Here's the problem, everybody, and this is going to sound crazy. There's a few things affecting this, but one, first of all, higher mortgage rates than we saw the last couple of years. By the way, historically, current rates are about average.
Right.
You look at the history of mortgage rates, it's between 6 and 7%, which
Yeah.
is where we are. But I get it. If you've been looking the last 10 years, this is way above average. So that spooks you. If you own a home today and you want to refinance and buy or sell that one and buy a new one, now let's just say you have to take out a new mortgage, well, you're not going to do that because the new mortgage might be very expensive. So that puts a damper on it. But the real damper is Chris on this one. It's kind of crazy. Back to where we started. The boomers are worth a whole bunch of money.
Mhm.
And when boomer sits back and they say, I'm pretty healthy, and my life expectancy is longer than I ever expected. I'm smoking less, I'm traveling more, I'm maybe exercising more. We're seeing expected life expectancy. Take the pandemic out, you saw
Mhm.
life expectancy increasing every single year. So what did the boomer decide to do? Well, we expected 90% of boomers to be in assisted living or downsized living beginning 3, 4 years ago and accelerating right now. Next year, the first boomer to reach 80 happens.
Mhm.
Well, guess what? 90% of boomers are still in their house.
Yeah.
90%. Only 10% have made that move. So here's the irony. In 5 years from now, we expect that number to flip. Will there be a high demand for senior living and assisted living? Why? Because at some point it makes it pretty hard to live at home.
Mhm.
But we are also seeing an explosion in at-home care. So what are folks doing? All that money they made in their house, or they made in the stock market, they're using that someone to take care of them in their home. They'd rather live out their lives in their home. I don't blame them. I'd rather live in my own
Yeah.
house too, especially if my house is maybe retrofitting it to me, letting me live there, whatever the case may be. Heck,
Mhm.
I went to family similar with my own mom and dad. So I think what you're seeing is right now a very tight supply because of no one wants to sell, even though they can make a lot of money because they don't want to refinance. They don't want to leave their home. The millennials won't spend up on the price. What could happen in 5 years? An absolute housing glut. Because
Mhm.
once these used homes start coming to market, I would think you're going to see prices come down 5 to 10%, no more. I'd be surprised if it's more than that. Especially if mortgage rates come down as well, you'll see that. But for today, the housing market is a bit of a mystery. So what you've seen, and I have concerns about this down the road, is the explosion in multifamily. I'm going to guess where you live, you've seen these, and Florida might be a little bit different. You've seen these really big multifamily buildings going up where
Mhm.
people are now living and starting their families. It's all over New Jersey, New York, the whole country. We've added on average 700,000 units the last 5 years. That's a lot of units. And geez, in 5 years, I hope there'll be people to fill them.
Yeah.
Because we'll see. It's a not a black swan. I don't think it's. Here's where it hurts the U.S. economy. People build houses, nails, lumber, bricks, all that stuff. new material. Building new houses is an economic stimulant, and we don't have a lot of new building. We should have been building on average 2.5 million homes per year since 2008 financial crisis. We've been building around a million. That's
Mm,
just not enough. So that's
okay.
part of the reason why we had a shortage. So now they're building multifamily, which again I don't love, but for the housing market, it's a mystery, and I think will be for a few years to come.
Okay, I've been holding off kind of my two larger ones that I was really interested in talking about towards the end. So this one, a theme has been true for quite a while. US growth outpaces international, but it seems like the big money managers keep getting this wrong. I mean, I'm meeting with clients, with the big money managers, I look at their allocations, they said like 25 to 40% international. And I know you kind of mentioned, it's a global economy and a lot of the US companies have that international exposure. And you did mention that year to date, international's up 8, but it seems like every year, the last 10 years, they predict international is going to outpace US and it doesn't happen. So what's giving there?
So that's a great question. And we as a money manager, back to my analogy earlier about looking at macroeconomics, the macroeconomics in Europe have been terrible. Macroeconomics in emerging markets have been terrible. And that's why I haven't gone there. To understand, your portfolio is a bit like a piano. From time to time, you want to fine tune it and make sure the keys are sounding the way they're supposed to sound. So you tweak your portfolio. Some firms are so stringent and follow this square box that they have to fit into that they're going to own it because if you look at all the data points of history of markets, it tells you that over a series of decades, it makes sense to have an allocation to international to lower portfolio risk and to
Mhm.
add return. Except back to this time is a little bit different. Europe has a terrible, terrible population growth rate. They are
Mhm.
shrinking rapidly. They do not have babies there. And they're not really pro-immigration. If you've seen some of the highlights of Germany and the unrest that are coming from some of the population that have moved in there. So what you have is in Italy, for example, my mom and dad are from there, my cousin, my family, they don't have babies. If they do it, it's
Yeah.
just one. They have a
Yeah.
0.8 growth rate. So now you got a lot of debt from history of debt and a very small underclass that's creating revenue. That's a house of cards. What it means is you
Mhm.
can't generate enough tax revenue to support the older folks. More importantly, you just don't get economic growth.
Yeah.
And without economic growth, you have less babies, you don't grow as much, and corporate profits wane. They become very muted. Add to it that Europe is old economy. They don't have the tech sector that we have. They still make stuff, but the whole world makes stuff now. The downfall of China, the reduction of China pushed Malaysia and Bangladesh and Vietnam and Jordan and Pakistan and Israel into the fold. All these
Mhm.
other countries that are now Africa to a degree are making stuff these days. So what you're finding is that because look at Mercedes-Benz, the cachet on Mercedes-Benz nowhere near what it once was.
Mhm.
And you don't see the sales and the profits are waning. Tesla replaced them in the United States. So point being, you look at a lot of the rhetoric here, and it's hard to make a bet on international. Why is he doing well this year? The potential of the settling of the conflict between Russia and Ukraine
Mhm.
means they might finally get some less expensive oil and gas. Now, the United States saved Europe with the liquefied natural gas we got to them. But that aside, I think you have the scenario where there's some headlines there. The U.S. dollar has weakened a bit. It's weakened because of the rhetoric coming out of Washington. Tariffs, maybe a slower economy, laying people off, the noise around Doge, all these things, the U.S. government being less of a spender have
Mhm.
weakened the U.S. dollar. That means there's thoughts that we might be falling into a slower economy. When our dollar weakens, their currencies get stronger. It's an inverse relationship, and it's because of the amount of current dollars in circulation. So that boosts their market a little bit, plus some of the headlines. But from a growth standpoint, it's really hard for me to point to them. So far, we're dead wrong. Our theme is wrong. And by the way, back to fine tuning, if we start to see real economic uptick there, and it starts to make some sense that we see the European consumer getting re-engaged and banks start to lend and they get economic growth, we'll probably make a bet there eventually. We'd just rather be late than early because we've seen this movie before.
Right.
By the way, if it does happen, it'll probably be for a few years. You
Mhm.
don't need to be, oh my God, I got to time it right. That's nonsense. Let's let this really play out. And we might be an investor in the second half of the year. And
Mhm.
then we'll probably own it for 3, 4 years after that, benefiting for years to come rather than make a bet on what might happen. We tend to like to be rather late than early. And by that, I mean, I don't know that we need to I'd rather lose less when markets are down for you
Mhm.
all and then make a bet on where the markets are going. And so international, interesting place to be. So far, it's the place to be. I want to see real earnings growth before we can make a bet there.
Yeah, it's only been a couple months, and for most of the people that we work with, their investment time horizon is so long
Yeah.
that what happens in a couple of weeks or a couple of months is kind of irrelevant. Those are little pieces of sand. on the beach that is investing.
Yeah.
Okay, so
But you got to be aware
finally,
of it. You got to be in tune with it. You
of
got to keep it
course,
for sure.
yeah, of course. So finally, we have some areas to watch, some things that you identified as being some not sectors, but areas in the economy and the marketplace to watch. These have been getting a lot of media coverage. I'm seeing some questions from clients more and more. The big two are kind of the AI wave. And then also crypto has been more normalized now as a been offered as an option through using an ETF. So maybe comment on those two things, not a suggestion as to whether you should do them or not, but just the impact that they're having on the
Yeah.
investing universe.
I have been, I won't say a bear on crypto, but I don't totally understand it in that I don't know who this guy Shinzo, what's his last name? Anyway, the person who theoretically created it in Japan, it's
Yeah.
one person or four, how you get the little coins built as pieces of algorithm stitched together. But for a minute, I would compare crypto to gold, and that there's a
Mm-hmm.
limited supply of gold in the world, and so it has a perception of value. Crypto's the same way. And what you've seen, in fairness to someone like me, we're really not even able to invest in it for folks, but we have to be aware of it, is that, the crypto market in of itself today is up 11,000% from just 10 years ago. It's the number one performing asset class by far. So there's something here that there's $2 trillion in it today. So you have to ask yourself, why I may not understand it, and I don't totally believe in it. I do think the blockchain is incredible technology, and it's certainly
Mm-hmm.
a commerce. You have aspect to it. The administration is certainly positive on crypto and the blockchain. So there is something here, and I think you're better off looking at, can I make money in the movement of it and the growth of the currency and not the coin themselves, the
Mm-hmm.
exchanging, the buying and
Mm-hmm.
selling of it, how it's going to be moved around. I think there's an industry being created around it, and that's what's fascinating to me. I don't want if someone asked me, should I go buy Bitcoin, I wouldn't make a recommendation because I just don't know.
Yeah.
But it's a little bit like gold to me too. I can't. Gold, it has never been a good asset class. If you look at its history, actually gold versus a diversified portfolio over the last 20, 40, 50 years, whatever time period you want, only returns half of a diversified portfolio. It's have a nice run right now. Why?
Mm-hmm.
Because every country in the world that is a fiat country, a developed nations country, currency, has thrown out so much debt that there's central banks around the world buying some gold because they're
Yeah.
worried about defaults.
Mm-hmm.
Okay, I think it's a little crazy, but okay. My reason for saying that is every country's backed by tax revenue. You can hopefully get our spending in order globally and domestically.
Yeah.
That's my biggest worry is the American debt problem, but we can talk about that last. But I guess when it comes to crypto, it's an emerging asset class I think everyone should be aware of. And if you're willing to be speculative and do it on your own, I would suggest you look at where the money's moved, how it's moved around rather than the coin. But I have been
Mm-hmm.
wrong. I'll be the first one to admit I've been wrong in that the performance is quite breathtaking when you think about who's made money here.
Mm-hmm. And how about AI? I mean,
AI, I just read a research report over the weekend that there's a new version of AI. So first was regular AI, large language models.
yeah.
And I know that sounds like a fancy word. All this is, everybody, imagine there's somewhere in your neighborhood, there's a big building with no windows. And in that and it's big on a bunch of air conditioning units on top. And inside that building, if you walked in there, you'd see these racks, kind of think about a clothing rack high to the ceiling. And on every little 2 by 2 space, there's a big black box that's called a server. And then in that building is probably 1,000 servers, and they got to keep that temperature at around 65 degrees, and they all
Mm-hmm.
generate heat. So AI one needs a lot of power, a lot of air conditioning, and a lot of power to turn on. Inside those servers are pieces of information. And that information comes from some company gathering that information. And it could be Google, it could be anybody, it could be a medical company, and they load those servers up with all kinds of data. So what happens is one, you need a lot of power to turn on those data centers. Two, the company loading on that data or data gets paid for it. And three, somebody like a Chat GPT or NVIDIA powering them looks at all that data, aggregates it together, and comes up with a summation. When you
Mm-hmm.
ask a chat box what it thinks about something, it's just giving you the aggregate of a bunch of different data points. It's no different than asking a really smart person what their thought is. I kind of love it for the medical industry, by the way. Our ability to have be able to understand what doctors tell us and self-diagnose ourselves is going to rapidly change over the next 5 years. You put your symptoms into a medical chat box, and it's going to tell you very likely what's wrong with you, and then you get a doctor to confirm or deny. So I
Mm-hmm.
think that's really powerful. But beyond that, AI to me is this phenomenon that's revelatory. It's changing us slowly. For fun, for those of you listening, if you're bored, go on to Google and just hit the Gemini button. It's a little star, and just
Mm-hmm.
ask it to make you a song. say, I'd like a country song or whatever you like that's got a gal singer and she's going to talk about sunsets and see what it does. In about 3 to 10 seconds, it'll produce a song for you that it will sing to you. I
Yeah.
mean, that's pretty amazing. Think about what that does to the future of music. My point is, it's just changing us. So the first revolution was how we're going to power these things. So I think there's an investment opportunity in energy. We need a lot of power for them. The second one is which of the chat boxes are going to charge money and make some money off it. ChatGPT tried; it's not really working. But the third one, there's a new piece coming out, and it's what's the term? Oh my gosh, I just read the report this weekend where it takes the data in a chat box and makes it smarter. It actually puts
Mm.
a human brain approach to it. And the term is, oh, I'm going to forget. Everybody, I'm so sorry. I'd have to look it up. I have it somewhere here in one of my notes from the weekend. But my point is that one's going to need even more power.
Mm.
So it's going to make a faster, better decision for us, but that one needs even more power. So what I think you'll find is this revolution that's happening in front of our eyes is going to change the way we live and work. And I'll give you a simple example. If you're bored one day, listen to Cold Fusion. There's a podcast out there called Cold Fusion. Of course, after you finish listening to Chris's, but listen to the Cold Fusion podcast, the one about AI and robots. And it talks about how remember there was this whole revolution we were going to get with AI and
Uh-huh.
that it was going to, and robots and how it's going to change the way, hasn't really happened yet. Infusing AI robots with advanced AI can teach a robot to wash dishes as easily and as quickly as a human, can walk, can talk. And what we're finding is this movement in AI could actually finally happen to really change robotics. So back to the folks who are going to live in their house because we're short 800,000 people in the medical industry for at-home care. It might be a robot taking care of you. And that's
Yeah.
where this stuff is going. I just found the piece I was looking for. It's called, easy enough, reasoning models. I don't know why I
Okay.
couldn't remember that. It's a reasoning model. So what you get today out of AI is just a piece of code, a surmised piece of code. But this is going to reason it and make it more logical, and it requires 10 times the computing power than the original one. That means more power, more energy. I think when I read it, it kind of reminded me of making it think more like a human, to be quite honest with you. But just without it's as if you and I had to figure out how to do a math problem, and we had someone teaching us all the different ways to figure it out. We get to the answer faster, something like that. My point is AI is a big part of our future. It's hard to embrace it today because I know it's not part of your reality. But if you want to go on a trip, just for fun, go into the free version of ChatGPT and just step in and say, I'm starting in Florida. I'm going to end in New York. What should I do along the way? And instantly you get an agenda. It's kind of cool. That's one
Yeah.
little way to try it out.
I've found there's some productivity benefits to it as well, and just saving time for things that I do. And I wasn't going to admit this today, but I might as well. I am an AI robot.
You look like one, so it's awesome.
I am I am not real. Okay, Phil. So we're getting kind of close to the end. I want to ask you some things people maybe should or shouldn't be worried about. A lot of questions around tariffs right now, right? And I guess tie that into should people be concerned about that? And what's usually the best advice that you give to people when we might go through? Haven't seen a lot of bad markets. We had one in 2022, but like you said, over the last 10, 15 years, really haven't seen those, but maybe some advice that you give to people. So start with
Yeah.
the tariff thing. You did a really good piece on this today. I read it, a white paper on the tariff, kind of the history of those, but maybe how it impacts today.
Yeah, and I'll put it in this simplest of way. Tariffs have been around forever. This is not George Washington was the first president to ever install tariffs. So it's not unusual that we try to protect some of our industry. I'll give you an example of some of the things that's probably very difficult for President Trump to get passed. We put 25% on tariffs for steel, which we make
Yeah.
our own steel or try to, and those tariffs were on Chinese steel. Well, that slowed down Chinese steel, and the Chinese steel went from being made in China to actually being made in China, being sold to Canada. Then Canada turned around and sold it to us for no tariff.
Yeah.
So if you look at where we were from what was our number one import country pre-tariffs of 2018, it was China. China's now number three behind Mexico and Canada. How they subvert it? They sold the stuff to Mexico and Canada, and they sold it to us for no tariff. So there is a bit of a even the playing field thesis and to protect the American steel industry, hence the Nippon U.S. Steel merger. But there's also this aspect that, for example, I had a conversation with a client who said he does have, when the last round of tariffs got hit on his business and he sells office furniture, he had to increase prices by 25%.
Mhm, mhm.
Then he was lucky enough to go to places like Malaysia, where they made office furniture at relatively lower costs, and he was able to offer different options but still an increase. So I'd put tariffs this way. It's a concern. As of now, it's a much more about trying to find a reward for them. I don't know if there's a direct line to revenue.
Hmm.
So if you think about reward, revenue, and then redemption to some degree about what's happened in the past, it is something we have to watch closely. And as of right now, we're already in a world where we're seeing high inflation going to be stuck here. What does it ultimately mean if tariffs come in and we see that if inflation stays stickier, it means that we're going to have to deal with inflation for longer. It means interest rates stay higher for longer. It means the housing market doesn't change, the bond market stays flat, and in fact, the U.S. economy just kind of gets a bit more expensive than it already is, which is exactly what we think is going to happen. We do think there's going to be
Hmm.
some round of tariffs. We think they're going to have some inflationary aspect to them. It's certainly not a revenue growth. You cannot create enough revenue from tariffs to make up for the idea of cutting taxes or lowering the deficit. So to me, hopefully it's just a leveraging stick to even the playing field because there
Yeah.
is some things that are bounce. A Harley Davidson motorcycle sold in India has a 40% tariff on it. Bourbon whiskey sold in France has a 25% tariff on it, and so on. There's lots of these. So some of this stuff is really unfair when European whiskey coming to the United States has no tariff on it.
Yeah.
So that's unfair. So can we level the playing field and be treated fairly? We have a $90 billion trade deficit every single month. It's not going to zero, but could it be 40? Maybe that's a possibility to level the playing field a bit. I think that's fair. But it is
Hmm.
something we got to keep a close eye on. And that's why I think just today was another announcement that Canada and Mexico are going to get tariffs. That's going to create market volatility. We're going to get sell-offs because of it. I want the folks to be prepared for this market not being nearly as stable as it's been.
Yeah. Yeah. Well, and the crazy thing about that is the European whiskey is not anywhere close to tasting as good as the American whiskey.
I've had
So,
Japanese whiskey. It's not bad. I
oh,
mean,
come on, Phil. You
I'm
can't
not an
say
expert.
that. You can't. You can think that. You're not supposed to say that out loud.
Oh, okay.
Okay, so
Sorry,
if
man.
we, so if we are going to maybe go through some volatility this year, well, I agree with you. It could be a more volatile year. What's the best advice we can give everyday investors when we're going through bad markets? I know it's don't panic, but maybe extrapolate on that.
I don't want you to be afraid of owning bonds. I think you want to, if you're running a balanced account, or even if you have an aggressive account, all equities, please take some profits from your Magnificent Seven and buy some bonds. Nothing wrong with having a hefty part. Why? Because if markets sell off, they're a great safe haven. I think it
Mhm.
is a good idea to buy. If nothing else, if you want to stay away from the risk of small and mid, I'd argue they're just same risk as the other stocks. But
Mhm.
large cap value stocks offer a great opportunity to be diversified and, more importantly, earn a nice dividend. So I
Mhm.
think it's time to believe in diversification again. I would say that's something you want to be aware of. I think you want to take advantage of corrections. If you end up having an opportunity because you've got some extra cash in your portfolio, you're not reinvesting your dividends, which I think you should. But if you don't, when you see a dip, buy into those dips. Ultimately, I think the U.S. economy is fine. It's chugging right along. If we end up getting lower taxes and lower regulation, which spurs some lending and growth, that's going to be good for the U.S. economy. We'll end up this year plus 8 to 10% on stocks and plus 3 to 4% on bonds. That's a solid year. Your balanced account's going to do a whopping 6, and you
Mhm.
should be happy with 6 because that means a risk
Mhm.
adjusted 6%. It's not the 15s and 20s of the last few years, but certainly it's a nice number. So I think that's the best advice I can give people. And again, don't panic. There are things that worry me, but I don't. I hopefully they'll understand that there's normal's not terrible. It's just boring.
Right. But normal's okay. Plain vanilla is all right.
Yeah.
It is. It's still America's favorite flavor of ice cream. So we like plain vanilla. We'll go with that. All
Okay.
right.
Can I
And
can I give one piece of fun reading for everybody?
yes.
For those of you who are Wall Street Journal geeks, and I am, I read it every day, cover to cover. I love it. Over this past weekend, there was a really good article, and I'm sure Chris can get it for you. It's a little, they don't really love, not a fan of forwarding it, but maybe you could just Google it because sometimes they'll put it out on Google for free. It's
Yeah.
called Debt Always Has Been the Ruin of Great Superpowers. Is the U.S. next? And why I mention that, I get asked a lot what worries me. And I think the valuations of the stock market are a bit expensive. I don't love being just in the United States. It's something to think about. The tariffs and all those things are some minor things to worry about. Nothing. The one thing that has me very worried, Chris, is today we're going to spend $1.2 trillion on interest payments on our debt.
Mhm.
That means the 34 trillion we have in debt is $1.2 trillion in spending. Now, don't get me wrong. There's roughly 7 trillion at the Federal Reserve. So you keep making money from the Treasury, giving it to the Federal Reserve, and then giving it back to the Treasury.
Yeah.
So
Yeah.
but in the end, when you spend more on your debt than you do on defense, say, that's the one sign that tells you, according to this article of Ferguson's law, that clearly that is the telltale sign of an empire that's beginning to fall apart.
Mm.
We have to get our debt in order. If we don't, today we're fine, but long term, the damaging impact on spending that much just on interest, it's like buying a big house, everybody, with a mortgage you can't afford because the interest payments are so high, you live just to pay the mortgage. That's kind of what we're becoming. And I think we have to be very aware that if it's not tariffs, if it's deregulation, it's just growing ourselves, whatever the magical mix is. And I have my own opinion, but I'll leave it to Scott Bessent, the new head of the Treasury Secretary, who I think is a really good guy, really interesting guy, to figure this out. But we have to get our debt in order. It's a problem.
I thought Doge was going to fix everything.
When I see it, I'll believe it.
Yeah, I think,
have heard
yeah,
like everybody else, heard some of these crazy numbers.
yeah,
And sure, maybe look, if you got to start somewhere. If it means this
yeah,
sets a precedent for every agency to be more
right,
mindful, I think
right,
there's 3 million people that work for the federal government. If
yeah,
500,000 get let go, Bill Clinton did the same thing, and we start
yeah,
over again and cleaner. Okay, but it comes down to you make 27 trillion a year. Your budget's got to be 27
yeah,
trillion.
right.
That's it. That's
Yes.
what I need you to do. I
That's
need you to
simple
figure that
financial
out.
planning. Yeah, exactly. Simple financial planning. Even
That's it.
clients get that. Yeah, you're spending more than you're making, and you can't sustain that over a long time. Okay, well, that's the thing that really worries you. So let's end on, you're an optimistic guy. One of the reasons I love you. What are you really liking right now, or what are you most optimistic about?
Well, American exceptionalism is real. At the end of the day, our demographics are great. We've got about the same people in the first third, the middle third, and the second. So we don't have a demographic issue. We've got all the commodities we could ever hope for. We've got the tech sector, which is blowing the doors off of everybody else. I mean, China's trying to keep up, but they're arguably a distant second, and Europe's even way behind that. So the diversified nature of the U.S. economy is what keeps me very optimistic. We've got education, which is a product. We've got agriculture, which is a product. We've got finance. We've got healthcare, and on and on. All these things, the tech sector, all these things that we do that make us unique and different. We've got immigration. I know for a lot of you folks down in Florida, you see a lot of illegal immigration. I'm going to leave that aside for a second. It sounds like we're getting to a place where we'll go back to legal. I'm a child of immigrants. My mom and dad were legal immigrants. I'm not picking sides here, but immigration is a boon to demographics. Immigrants have
Mhm.
babies. They work in labor. They grow us. As
Mhm.
long as you got a growing population and a diversified economy, ultimately you're going to be just fine. So don't panic about tariffs here or there, or maybe some of the social stuff you can get mad about. I don't mix up into that stuff. I stay out of that. But economically, we're in pretty good shape. If we just get our debt in order and grow the size of the U.S. economy, we're going to be fine. That's not our issue. It's just a matter of, just think of it this way. Chris knows this as well. This $80 trillion that's starting to go into motion really in the next couple of years here from one generation to the next. That's an economic miracle. All that money going from one place to the next, the boom in housing, the boom in money going to new generations that are going to spend some of it, which is okay. So long term, I think we're going to be fine as long as we kind of knit together the fabric of a healthier economy through being mindful of our debt. And for this year, I just think folks got to be aware that what we saw since 2008 forward were, granted, there was a couple of tough moments like 22,
Yeah.
but by and large, some really incredible moments of pumping up the sides of the U.S. economy. It's time for the growth to catch up to the spending. That's it. As long as we do that, we'll be okay.
Okay. All right. Well, I want to really thank you for being here. This was a pleasure today. Always a good time to hash things out with you. And I want
Always
to
fun,
thank,
buddy.
yeah, and I want to thank everybody for joining us for our 2025 Economic Outlook session brought to you by LPF Advisors. If you like the episode, please consider subscribing to the podcast and sharing it with other people that might find it helpful. You can contact us at lpfadvisors.com or emailing us at info@lpfadvisors.com. I hope everyone has a great rest of 2025. Be well. Thank you, Phil. Thanks again, brother.
Love you, buddy. See you soon. Take
All
care.
right.
You've been listening to the Confident Retirement Podcast with Chris and Mark from LPF Advisors. For more information on them and retiring confidently, please visit lpfadvisors.com. If your ears are pleased and your mind is now at ease, do share the program with your friends and subscribe wherever podcasts are found.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.